There we go. Good afternoon, everyone. Good afternoon, Mike. How are you?
I'm doing well. Thank you for asking. Hope you're doing well as well, Lauren.
I am. It's a beautiful sunny day outside today. So as soon as we're done in the office, maybe we can go outside and
That'd be great.
soak up some sun. I'm going to quickly get my screen share going. Here we go. So good afternoon, everyone. Thank you for joining us today. My name is Lauren Simpson. I'm with the SBDC, or the Small Business Development Center. We're a national program with over 1,000 locations across the country. So regardless of what state you might be in, you should be able to get connected with a local SBDC office. And you'll want to do so because we offer no-cost services for local small businesses. And it's at no cost to you because your tax dollars have already taken care of our fees. So you might as well partake in our free resources. Here's a deeper dive into what it is that we offer: no cost business advising. And so you're able to meet one-on-one via Zoom currently with one of our business experts. And we've got experts in various genres of industries. And so we've got marketing, there's also business planning, which we were just speaking about, as well as taxes, you name it, we've got it. Alma, I see your hand raised. I'm going to continue through the intro and then maybe you can drop your question into the Q&A. And then we also offer virtual trainings, much like the training you have joined today. And so we are here to help. Be sure to get in contact with us. Oops, I'm sorry, I have the wrong email on the screen right now, but you can get in contact with us and we would be happy to assist you. I'm gonna list some contact information into our chat. And then if you guys are looking to get in contact with Mike or GB, again, please list that into the chat and we'll get you some assistance. And so with that, Mike, I'm gonna hand it over to you.
Well, thank you. I appreciate it, Lauren. GB hasn't made it onto this presentation, so I'm going to share with you some information concerning accounting basics. Now, I do realize that many of you already have accounting in place, already have your business in place, so some of this may be a refresher, and this may not take up the whole hour. A couple other points: please keep the Q&A to the topic at hand. If you raise a topic other than what I'm covering today, Lauren and I will ask you to seek out an SBDC advisor or another professional, because our time is precious and we want to stay focused on the topic. So with that, I'm going to go ahead and share my screen. Give me a second. Did you already mention about the California Dream Fund, Lauren? Did you talk about that?
Honestly, I did not. Thank you.
Do you want to talk about that first? Go ahead.
Sure. The California Dream Fund is going on, everyone. So please, if you are a brand new business, be sure to get in contact with us. Actually, just go to smallbizla.org/dream fund. Again, I'll list that into the chat so that you can click on that link and fill out the registration form. We'll have some communications going out between this week and next week that announces the other tracks that we'll be conducting. So again, if you are a brand new business, you will go through our training program and then be able to be eligible to apply for a $5,000 or $10,000 grant. So again, I'm going to list that URL, Mike, into the chat so that everyone can click on it and then get over to that landing page and get some more information. Thank you for the reminder.
Sure. Hi, GB. How are you? Sure. Yeah, you're muted, GB.
Can you hear me?
Yes.
Perfect. Sorry to keep you guys waiting.
No, it's not a problem. Do you have something prepared for today?
Yes, today we're going to talk about CalSavers and some of the do's and don'ts, because the deadline is just around the corner and a lot of our participants may themselves or know somebody who may require to register. All
right, so that's what we're covering today. So once again, sure, please keep the questions to the topic at hand, which is CalSavers and retirement plans. Thank you.
Thank you. Give me a moment to start sharing. Let's see. Do you see my screen?
It just came up, GB.
Perfect. Excellent. So CalSavers, it is a new requirement. Well, actually, it's been around for some time, but it may be a new requirement for a lot of our audience members and or their friends and family, basically requiring all employers to either offer a retirement account plan, or if they're exempt, then claim that exemption. And if they're not exempt, what happens if you become exempt or if you become non-exempt later on? So that's the topic today. So it's not a choice. Whether or not you want to participate is not a choice. If you are non-exempt, which means you don't have an exemption from the program, you must register. And a lot of people who may think they are exempt for one reason or another are still suggested to register anyways if they meet the employee threshold, because it's such a new program. The expectation of many industry experts and many of my peers is that though you may be exempt, if you fail to register, you may get a non-compliance letter. So it's better to just take 5-10 minutes to register yourself and tell the state that I'm exempt, leave me alone, rather than having them reach out to you and say, hey, we think you are eligible, you failed to register, here's the penalty, come deal with us. Right now, a lot of tax agencies, including EDD and Franchise Tax Board, are overwhelmed. So it may be beneficial to a lot of our attendees to register nevertheless if they are required to, and avoid a battle down the line. So for most employers in California, it is not a choice. If you have 5 or more employees, you must register by June 30th of 2022, assuming one of those employees is over age 18 or over. Because a lot of times, especially in my private practice, a lot of clients say, well, GB, I don't have enough employees. Well, you may be surprised to learn today who may count as an employee for the purposes of determining if you have 5 or more employees or not. If you do have 5 or more employees as defined by the state of California, and you do not offer a retirement plan, an employer-sponsored retirement plan of your own, your employees may have their own IRA. They may have a side hustle. They may have a SEP IRA. That is their business. In your business, if you do not offer an employer-sponsored retirement plan, then you must register and offer the state's CalSavers plan, which runs very much like a Roth retirement account IRA. Now, this is a mandatory enrollment for all private employers who have 5 or more employees, which you may have a 401k, you may have a SEP IRA, you may have a simple plan, some other plan that you're already offering, but the state may or may not know. They do have a mechanism where they may find out and not bother you, but the suggestion is if you are exempt, or if you already offer a plan, register nevertheless so that you cannot be bothered. And like I said, if you do not follow the protocol, there will be a penalty down the line. How much is the penalty? We don't know yet precisely. And on what basis will the penalty be levied? We don't know 100% yet. This is a third tier of compliance. Anybody who had 100 or more employees, 50 or more employees, they had deadlines in 2020 and 2021. 2022 is a deadline for anybody who has 5 or more employees as defined by the state. Before I go on, Mike, anything you have heard about the program, anything you want to add, sir?
Other than the fact that the vast majority of people that we see aren't even aware that this is mandatory. They don't know that this is a requirement.
Exactly. So this is where, that's why I chose to do this program, because June 30th is just a few days away, a few weeks away.
The state of California has not done a good job informing businesses of this requirement.
Yes, unfortunately, that is true. And there are many different reasons for that, but c'est la vie.
Okay.
So what are the exemptions? The entities, the businesses that are exempt are private employers who already offer a retirement plan. Now, assuming you've been offering a retirement plan for a while, there must be a Form 550 that is filed by your plan administrator. If you have 5 or more employees as defined by the state of California, you may already have a Form 5500 on file, and California may, at least they claim, California state claims they may check that registry and say, all right, we checked it. You've been offering a 401k plan for last 3 years, 5 years, 4 years, fine, you're exempt. But if you receive a notice, maybe you start offering a 401k plan this year in January, anticipating this, your form may or may not be filed yet, or it may or may not even show up in the state registry. So you may receive a notice from CalSavers saying, hey, we believe you are not exempt, and we believe you don't have a file, form 5500 filed, respond. And that may take a while. So this is where it may be beneficial to go to this website, employer.calsavers.com/home.html, to register yourself just to cover all your bases and tell the state, I'm registering and I'm exempt. They may leave you alone. If you are a private employer that has union employees, you have to register, but you don't have to offer this. And this is where if you have union employees and non-union employees, then you have to just register. You don't have to offer CalSavers. Your non-covered, non-union employees need to self-enroll themselves into CalSavers. Do not try to help them. We'll come to that in a few minutes, but the main theme of this presentation is do not try to help your employees. There are consequences for that. Also, if you are, sorry, go ahead.
That was a quick question. Does
Yes.
CalSavers apply to sole proprietors and self-employed individuals as well?
If you have 5 or more employees as defined by the state, yes, it does. It applies to LLCs, corporations, S corps, partnerships, sole props. If you have 5 or more employees as defined by the state of California, yes, you must register with CalSavers. Good question. Anything else before I go on?
Yes. Why don't you explain what a Form 5500 is?
It's an annual form that is filed. It's either 5500 or 5500 EZ that lets the state know that somebody is a trustee of the retirement account, and if you have more than $250,000 in that retirement account plan, then the compliance goes up. But it's basically a form that is filed letting the state and the IRS know that you are offering a retirement account plan, you are withholding somebody's money, somebody's trusting you with their money, and you are properly putting that money with a trustee, and you're not just pocketing that money yourself.
Yeah.
It's no different than payroll taxes. Somebody who works for you, and you may pay them $1,000, you withhold $200 in taxes. You'll be surprised how many employers are tempted to pay expensive with that $200. So the 5500 also let the state know that, hey, not only did I withhold somebody's payroll taxes, I also withheld $50 in retirement account, and I put that with the trustee. I'm not using it personally in my business.
Makes sense. Please continue.
If you are a nonprofit, by default, even nonprofits are required to offer retirement account plans or register with CalSavers unless you are a religious organization. So a lot of times people think, hey, I'm a nonprofit. Nonprofit comes in many flavors. And within those flavors, there's sub flavors: chocolate with mint, chocolate with chocolate chip, chocolate with whatever, right? So this is where if you are a 501c3 organized for a religious purposes, maybe a church, a mosque, a temple, or whatever, you may be exempt. But if you are a 501c3 for public benefit, 5 or more employees as defined by the state of California, you must register or offer a retirement account. Of course, federal, state, and local government organization, they gave themselves a self-exemption. So if they don't offer a retirement plan, they don't have to register with CalSavers. And here's the thing. You may have 5, 6, 7, 8, 9, or 10 employees, and none of them want to save money for retirement. And you get it in writing and you fill out the proper forms as provided by the CalSavers that yes, as an employee, I'm opting out. You still must register with CalSavers and let them know that my employees do not want to save for retirement. This burden is on your shoulders as the employer. You can't just say, well, nobody wanted it if I didn't register. You will be penalized because the state doesn't know. And this is why you don't want to help your employees in any way, because later on, They could claim that my employer basically forced me to opt out of it. So if you are going to opt out of it, use the proper forms from the state. Don't offer any help, don't offer any guidance. Your responsibility is to simply say, hey, I'm offering 401k or SEP IRA or something else, or I am not. I'm registering with CalSavers. Who wants to participate? If all of them say, I don't want to, doesn't matter. Now, here's the deal. Maybe you have 5 employees as defined by the state of California, and 4 claim that they don't want to participate. 1 who's 18 and over claims he or she does want to participate. You must register and you must offer CalSavers.
GB?
Yes, sir.
Somebody's asking about the access codes. He received an email, she received an email stating that it'll be sent via email. And although they haven't even registered yet, do you know anything about the access codes?
Yes, the access code is being sent to a lot of employers by default, and they keep that code very safely because you will need it to register your entity with the CalSavers. And if you haven't received it yet, go onto the website that I've listed here, the employer.calsavers.com, and request an access code if you may have deleted it or you lost it or you haven't received it. It's no different than the EFTP, or it's similar to the EFTPS number that the IRS sends out anytime you register for the EIN number. Good question.
All right.
Anything you want to add, Mike?
No, keep
Perfect.
going. I'm on it.
This might be a short presentation, so we may have a lot of time.
That's okay. I have another presentation to go over.
Perfect, perfect. Let's see. So who is non-exempt? As we discussed, anybody, any private employer, LLC, sole prop, partnership, corporations, LP, LLP, any organization you have in the state of California with 5 or more employees, you are non-exempt. You must either offer a retirement account of your own, or you must register and offer CalSavers. Now, here's the deal. Even if you have 5 or more employees today and tomorrow you fire 2 or 3 employees, are you all of a sudden exempt? No, you're not. Once you are a non-exempt employer, you remain a non-exempt employer unless you end up with only 1 employee as defined by the state of California. So if you end up with just 1 employee, then you must contact CalSavers and opt out of it. If you have 10 employees, you drop down to 2 employees, you still must continue to register with CalSavers or offer your own 401k SEP IRA or your own retirement account plan. So once it's kind of like the mafia. Once you're in for life, unless you dwindle down to 1 employee as defined by the state of California. Also, nonprofits are not exempt. They must offer retirement account plans or register with CalSavers unless they are a religious organization. If you are a new business or a growing business, if you opened after July 1st, 2019, or let's say today you only have 4 employees, but maybe 6 months from now, you end up with 5 employees or more as defined by the state, you must register with CalSavers within 24 months. So they give you quite a generous timeline to do so as of right now. It may change tomorrow. Next year, they may say 12 months, 6 months, 30 days, whatever it may be. But as of right now, because it's a brand new program, if you grow to 5 or more employees, you must either offer or register with CalSavers within 24 months. If you are a temp agency, it is your responsibility to offer retirement account plans or register with CalSavers. And if you are registered with a PEO, which is a professional employer organization, where basically you will have employees, but their payroll is run by ADP or somebody else, like they are professionally doing it, it's your responsibility. Because a temp agency is different from a PEO. So if you have 5 or more employees, but you use a PEO, it's your responsibility, the client of the PEO, their responsibility to offer retirement account or to register with CalSavers. Any questions that may have come in, Mike?
No, but I don't think we discussed why this has been put into place.
Why don't you do that, sir? Give me a little break.
Sure. Well, my understanding is that the savings rate for workers, especially lower income workers, is particularly low, and that the vast majority of lower income workers may not even have a month's worth of savings. So this is an attempt to put a discipline in place for workers to save for retirement. Because
You're
Social Security is
absolutely
not supposed to be the only source of retirement funds.
correct. Unfortunately, according to Social Security Administration, 25% of US population retires with less than $1,000 to their name. Depending upon what year it is and how well the economy is performing, unemployment, inflation, all that jazz, a good 60 to 70% of US population retires with approximately $100,000, which to a lot of people, $100,000 sounds like a lot of money, but an average retirement is 20 years. $100,000, especially in the state of California, will not last you 20 years. According to Social Security Administration, only 5% of the US population retires with enough assets, 401k, real estate, cash, gold, whatever. Only 5% retire with enough assets to survive or thrive in their retirement without relying on their government, church, family, or somebody else. According to Dave Ramsey, 75% of US population cannot cover a financial emergency of $1,000 or less. So these are scary statistics. So because of that, this is a forced method to at least give people an opportunity to save. And if they won't, c'est la vie. But this is, you're right, Mike, this is an opportunity to at least, if not cure, then put a dent in the negative savings rate that we suffer as a nation. Will it work or not? Time will tell.
It will have an impact, but we'll see how much of an impact.
Exactly. And if it's a negative or positive impact, that is to be seen as well. It will have an impact. I agree with you.
Right.
So what counts as an employee as defined by the great state of California? Well, if you have a W-2 employee, by default is an employee. Anybody who's 18 years and older. So you may have your kids working for you, 16, 17-year-old, they do not count. An employee is somebody who is 18 or over. They could be part-time, they could be seasonal. So somebody may have worked for you only for a day last year because you called them in for Black Friday. Guess what? They count towards the 5 or more count. So they look at, if you look at the last bullet point here, they look at the average number of employees from your previous year's DE9C. So you may have reported over time that you maybe hired some seasonal workers, you hire some occasional workers, you hire some temp labor, whatever the case may have been. If you reported anybody on your DE9C, they look at your DE9C for the previous year and they take an average. Sometimes you had more, sometimes you had less. Somebody may have only worked for you for 1 hour. That counts, that can affect your average. So if your average for the previous year is 5 or more employees, they count. You must offer retirement account or CalSavers. So this is where you may even have a non-resident employee, but you withhold their payroll tax for California purposes. For example, maybe somebody was working for you during the pandemic, they moved to Arizona, Nevada, New York, but they are non-resident, but they're still domiciled. I mean, some of you may remember, I did a whole presentation on residency and domicile requirement a few weeks back. So you may have somebody who may have moved out of state, maybe a non-resident, but is still domiciled in California. They count. Also, if you are a sole prop, you count. So what does that mean? You may be a sole prop and you may have 4 employees, part-time, seasonal, out of state, whatever. Guess what? You have 5 employees, even though you're a sole prop. You count as 1 because you pay self-employment taxes. You're a self-employee. If you are running a partnership and you're a partner in a partnership, the 2 of you or more of you count as employees. So a partnership with 3 partners with 2 employees has 5 or more employees. Why? Because partnership Any ordinary income reported to you on K1 is subject to self-employment taxes. So you are a self-employee of your partnership, you count. You may not be on payroll, you only get a K1. If you are an LLC member, disregarded for tax purposes, you count. Maybe your LLC is a partnership, you and your partner count. Maybe it's 4 people running an LLC. Only have 1 employee, part-time. You must register, you must offer to that part-time employee 18 or over CalSavers or your own retirement account. A lot of people don't know that. They think I don't have employees. You have an LLC, disregarded for tax purposes, or a partnership. You may have an S corporation, LLC tax as an S corporation, corporation tax as an S corporation. Maybe you make enough money. Maybe you and your spouse have to give yourself a reasonable compensation as stipulated by the IRS. Maybe you only pay yourself, I don't know, $500 a month. You 2 are employees. You have somebody part-time helping you out, 5 or more, you count. All of you, you must offer. So this is where, unfortunately, a lot of people who may think they don't have to worry about it, they do because they're running a partnership or an LLC or a corporation or even a sole prop. Now remember, some of you may be a sole prop, but you may be a joint venture because you and your spouse work together. You both take income, 2 right there. If you have 3 part-time employees, you must register with CalSavers. You may have everybody opt out of it, but you still must register by June 30th, which is just around the corner. Also, some of you may have household employees, which is what? If you pay anybody about $150 a month regularly. So maybe you have a cleaning lady, or maybe you have a nanny. Well, first of all, assuming that you're properly reporting a household employee, somebody who's regularly coming in to take care of your kids or your house or cooking for you, and you pay them about $150 or more per month, guess what? They're your household employee. So if you're a sole prop, that counts as an employee as well. And if you're not reporting them, you may have other payroll issues down the line. So be careful of that. So the point of this slide is to share with you, not to scare you, but to share with you how the state defines who an employee is. Anybody getting a W-2 or anybody having any income subject to self-employment income, partners and LLCs, members and shareholders, or even sole props, household employees, so on and so forth, you reach the threshold of the state's definition of 5 or more employees, you must register with CalSavers, offer CalSavers, or offer your own retirement account plan. Any questions or anything you want to add to that, Mike?
No, perfect. Thank you. It's good.
Now remember, because you're the employer, if you have to, all of the responsibility will fall on your shoulder. So a lot of times I'm advising my clients, it may be beneficial to offer your own retirement plan. You may spend a few bucks every single month, depending upon how many employees you have, in offering a 401k or a SEP or a simple whatever plan. You may spend a few bucks, but now you're shifting that liability onto another company. Because if you don't offer a retirement plan and you're eligible or non-exempt for CalSavers, you must register all of the responsibility that we'll talk about in a few minutes. And I'm going to talk about very briefly. The responsibilities are quite large, but I want to talk very briefly. All those responsibilities are on your shoulders. And unfortunately, a lot of payroll companies are choosing not to comply with the CalSavers. They're simply saying, hey, we have a retirement account plan we can sell you. Buy ours. Otherwise, we'll run the payroll for you. CalSavers is your responsibility as an employer. You must manage it. We don't want any part of it because they understand it's a government plan. People want free healthcare. They want free all this stuff. It comes with a lot of compliance. Many payroll companies do not want to deal with the compliance. They much rather sell you a SEP or a 401k or simple or some other plan of their own that they know how to work in the private sector. They can control, file a 5500 for you and call it a day. Now, Is it a good idea for you or not? Talk to your advisor, financial, tax, and otherwise. But there may be some benefit in offering your own plan. Otherwise, the responsibility is on your shoulders. Would you agree, Mike? The responsibility can be arduous at
I
times.
mean, yeah, there's something called third-party administrators, CPAs,
Yes.
that will handle
Yes.
this. And if you haven't heard that term before, you will be exposed to it quite shortly.
Yes.
Okay. And they get paid. It's not outrageous. They get paid a reasonable fee for doing what they do. Yeah.
SEP
So-
IRAs are cheaper to maintain.
Yeah.
401ks are a little bit more expensive, but they offer sometimes more protection, more frills, and it all depends upon what you're looking for.
Well, the other thing is this is what we should be doing. We should be offering employees an opportunity to save
Correct.
and possibly contribute. That's what you want. It helps create a mutual respect between employees and the company.
Correct.
So there's a
Correct.
question to come in, and I'll answer this one. What if employees are independent contractors? First of all, employees cannot be independent contractors.
Correct.
It's one or the other. Do they have to register? Well, as GB said, you have to be a W-2 employee, as you can see on the screen. Okay. The other part to that question is about the treatment of workers. Should they be classified as independent contractors or employees? A couple of weeks ago, we went through AB5 and how it applies. The short answer is all workers must be employees, must be on W-2, unless they meet a specific exception, like a business-to-business exception, professionals like GB, doctors, lawyers, accountants, engineers. Okay. Anything else about that?
No, I think you covered it very well. And I'll just give another gentle reminder, never call your independent contractors employees. Never, ever, 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 ever. That's a cardinal sin. They're workers, independent, not your employees. So.
And there should be an independent contractor agreement in place. There's all sorts of rules that you have to follow if you have independent contractors.
Exactly. And I think we covered last week how the IRS can, or even the Franchise Tax Board can reclassify your workers as employees. Now, this adds another wrinkle to it, because now, if that happens, not only are you on hook for taxes and penalties and interest, oh, by the way, you should have been CalSavers compliant. You were not. Here's another penalty and interest and all that stuff that comes along with it. So be mindful. This gives the state another ammunition to use against you if you are deemed to have misclassified workers. So be very mindful of that. June 30th is just around the corner. All right. What is needed for registration? Of course, you need the code that somebody else brought up a little bit earlier. You need your legal name, as an employer, especially if you are an LLC, corporation, partnership, and such. If you do have a DBA, you need that as well. You need your FEIN, which is your Federal Employer Identification Number, issued to you by the IRS. You need your California payroll account number. You need your physical address, your mailing address. Who is the designated individual taking responsibility? Because any company is just a piece of paper, whether it's articles of organization, articles of incorporation, whether it's a DB, it's just a piece of paper. Somebody must take personal responsibility. That if something goes wrong, you're it. We're going to come talk to you. We're going to hold you responsible. So and you need that person's name, address, and email. And you need a list, a roster of your employees, including yourself if you're a sole prop, including yourself if you're a partner in a partnership, or a member of an LLC, or a shareholder in an S Corp or a C Corp. You need everybody's roster, because everybody has to be, because these are the employees of your entity as defined by the state, causing you to meet the threshold of 5 or more employees. Anything you want to add to that, Mike?
No, this is great.
Now, employee guidance,
There we go.
right?
Oh, well, before you go on, we have a question.
Yes, sir.
If someone's a sole proprietor or a nonprofit and they don't have employees other than themselves, possibly, do you still recommend that they be proactive and register?
No, because if you're just a sole prop, you have no employees, you probably don't have a payroll account, You probably don't file DE9 and DE9Cs. You don't have to worry about it. This is only if you do have employees, whether you're sole prop or anything in any capacity, you're okay. Assuming nobody can be reclassified as your employee down the line. So assuming that it's only you, and or assuming you only have independent contractors, you are properly issuing all 1099s, they pass the ABC test, and nobody can be reclassified, you should be A-okay. Should is a key word.
Okay, please continue.
Thank you. So employee guidance, don't do it. Do not offer, even if asked, be a jerk. Even if asked, do not offer any guidance to your employees. You are mandated by law not to offer any guidance. You will be in a heap of trouble if you offer any guidance. This is why sometimes having a TPA to run your 401k or SEP IRA may be beneficial, because you can tell them, hey, talk to my employee. If you are an employer, you must not provide any guidance. I cannot be more clear about this. Do not help, even if asked, do not help at all. When you register and you give them the list of employees and their contact info, CalSavers will send them information. They will not offer help. They will send them information. Your employees must rely on CalSavers information to make any and all decisions. You cannot, if they ask you, hey boss, you think I should opt in or opt out? No comment. Do not say a word. If they have questions before or after they receive information from CalSavers, you must refer them directly to go to CalSavers to ask any questions. If they can't get any proper help, if they're crying that, hey, there's nobody answering my phone, or I didn't get the proper help, I'm sorry, I cannot help you. I tell them, by law, I'm precluded from helping you. You must not help especially, this is another key one, you must not provide any help with investments because you are not a licensed professional. You don't have a Series 7 or a Series 63 or 65. Sometimes people ask me, GB, what do you think of this? I don't. I think for myself, you think for yourself. Don't give them stock tips. Don't tell them, oh, I put my money in this thing, you should do it too. Nope. Now you're part of CalSavers. You do that, and if they lose money, they are allowed to sue you and recover damages from you. That, hey, boss, you told me put money in Tesla. You told me buy Amazon. You told me buy this or that. I lost money. You must make me whole. Get me out of this hole. Do not offer any help. Cannot be more serious about this. You must provide the roster to CalSavers within 30 days of registration. They will send them information. They will tell them how to contact them and all that stuff. Do not offer any help. And if you have a new hire, they must be added to CalSavers within 30 days of hire or becoming eligible to participate in CalSavers. So all of this is your responsibility. Do not offer any help. Don't give any stock tips. And this could be true. Maybe you're hanging out with your employees on a Sunday at a beach barbecue or after church. Don't talk about business. Don't talk about investments. Do not tell them anything. It's not your place and you're not licensed. Anything you want to add to that, Mike, or any questions that may have come in?
No, you nailed it. There's a liability issue. There's a fiduciary duty to protect your employees. You breach that fiduciary duty by engaging in activities for which you're not qualified.
Exactly.
So if you don't have those licenses, even if you do, don't do it.
Sorry?
Even if you do have those licenses, don't do it.
Yeah. Like for example, a lot of my clients with Series 7 investment license, they cannot write a blog post because they are precluded from that. So even people who are licensed, they're taught, be careful, be careful, be careful. If you're not licensed, oh, just don't even touch it. Contributions. Who can make the contribution and all that stuff? So within 30 days of registering and all that stuff, it is your responsibility. Maybe your payroll company will help you with this. Maybe they won't. Many have already said, hey, we don't want to touch this. We'll offer you our plan. Want to take it? Great. If not, sayonara, you do it and you let us know how much you withheld. You as an employer has the responsibility from their paycheck, each pay period, so you're running it every week, every 2 weeks, or twice a month, to collect, remit to CalSavers, EDD, and report contributions. Your responsibility. Your employee on their own CalSavers profile have the option of choosing a contribution rate of 5 to 8%. And they can change it whenever they want to. They can change it whenever they want to. Sorry, I couldn't put that sentence together for a moment. So this week you run payroll, they want 5% contribution. Next month or next week, 8%. The following week, 6%. The following week, 7%. I mean, if your employees don't like you, they can make your life a living, miserable hell by just changing. And so it's your job to go into CalSavers, check every pay period, what contribution limit your employee has chosen, have they changed it or not, and withhold, collect, remit, and report accordingly. You have to do this every pay period. This is why many payroll companies don't want to touch it. Like, we're not going to worry about this stuff. Like every pay cycle, we have to go and check, did this employee in CalSavers make a change or not? If your employee doesn't make an election, the default rate is 5%. And they can opt out at any point. So maybe they're really excited. Thank you, boss, for setting this up for me. I want to contribute, and next month, like, shoot, I can't pay my bills. All right, boss, I don't want to participate. They don't tell you, you don't do anything. They go into CalSavers. They tell them, I want to opt out. You must check, and they can opt in again later on. So you can imagine the compliance on your part. Now this, because it's a Roth IRA-like plan, as I mentioned on screen 1, you don't have to make any contributions. Actually, you can't, even if you wanted to. This is an employee contribution plan only. For example, if you have a SEP IRA, only employer can make a contribution, not the employee. So each one of these retirement plans has its own nuances. A lot of people know about 401ks. I'll put in some money and my employer will match. That's a 401k. SEP doesn't allow for that. This CalSavers does not allow for that. Your employee makes an election or may not make an election or opt out or opt in every pay cycle. And your job is to check and honor their wishes, collect from their paycheck, remit and report. So this is where your payroll company may not do so. So this is compliance on your shoulder to do on CalSavers. Anything you want to add to that, Mike, before I go on? Or any questions?
No, but to be clear, you always have the option of going to a different program like a 401k to do the match. Right? You don't have to do CalSavers. You have other options.
Correct. Absolutely. Let's see. Investment options. Now, these are options only for your employee. You must not help in any way. Mum's the word. No comment. Leave me alone. Get out of my office. Whatever you want to say to your employee. Don't get into trouble. If your employee doesn't make an election, how they want their money to be invested, CalSavers will by default put their money into a money market account. As some of you may already know, money market account is kind of like a savings account, and it gives you a little bit more interest or a little bit more risk. So that's what they put their money. If the employee doesn't go into CalSavers and doesn't make an election, then after 30 days of money market, that money, CalSavers will then move into a target date fund based upon their age. If you don't know, a target date fund is basically, hey, how old are you? You're 18, great. You will retire in 50 years. We will allocate money for you based on that. So we'll be very aggressive because when you're young, you can afford to lose money. You will make it up again. But hey, how old are you? 55. Oh, we'll be conservative. You will be retiring maybe in 10 or 12 years. So we'll put your money more into bond and more legacy blue chip companies. So these are investment fund managers who build a fund, a mutual fund basically, with a target date, and they reallocate assets accordingly. So if your employees don't make an election, their money will be moved directly into a target date fund based on their age. They're 18, 28, 38, so on and so forth. If they want to, with no help from you, they can get help from a licensed advisor on their own. CalSavers will not do so. But if they want to, on their own or through advisement from a licensed professional, they have the option of moving their money from a money market account to a target date fund, or a sustainable balance fund, or a core bond fund, or a global equity fund, or a money market fund. So they have all these options. Do not help them. Cannot say that enough times. Don't give them stock tips. Don't tell them anything. Mum's a word. But if they want to, they can do whatever they want with their money. Any questions or anything you want to add to that, Mike?
Yes, somebody's asking if they can put a 401k program in and not do a match for all employees.
I'm sorry, say that one more time, please.
Someone wants to know if they can have a 401k program without a match.
Yes, you can. It's an incentive to attract and retain talent. You have no legal obligation to match.
But there's top heavy rules, which
Exactly.
means it's meant for everyone to participate. So if only the heavyweights, so to speak, the executives participate, it may not be appropriate. In other words, it may be a refund of those monies back to those executives because it's top heavy.
I've read the book on, or one of the major books on retirement accounts is this thick. So there's a rule, an exception.
Right.
Just so many. This is why sometimes it's better to hire a professional, because if you can take your time to read that thick book. I did. It was fun. My wife calls me a big nerd. I love this stuff. But if you're not so inclined, I mean, the example, my wife, she's a great cook. But when we go on a date night, I take her out to a nice restaurant. I don't tell her, hey, honey, it's a date night. You're cooking. I spend $20 on a meal that she can cook far more healthier, far more delicious for $2 at home. The date night. So I pay extra $18 plus tip, plus all that jazz. So right. Sometimes it's worth it to pay a professional for an experience or a lack of an experience, because this could easily translate into a bad experience for a lot of employers. So be mindful. Can your employees take the money out? Yes. Do not tell them to. Do not give them any advice. But should they need money, they can withdraw their money at any time. That's one of another feature of a Roth IRA like CalSavers plan. So maybe they're putting money in, they're really excited, but sometimes life throws lemons at you and you need the apparatus to buy a glass or a juicer to make lemonade. So maybe they need the money, they can take it out at any time. They may have tax consequences, may or may not. If they are withdrawing their contribution, because it's a Roth-like plan, because some of you don't know, there are two major types of umbrellas under which all retirement plans are classified: traditional and Roth. In a traditional retirement account, you put money in, you get a tax deduction with the idea that when you take the money out with the contribution, you will pay taxes then. In a Roth, you put money in, you get no tax benefit right now, but as your investments grow, they grow tax-free. So if your $1,000 becomes $1 million, people will hate you for it. And they will say you don't pay your fair share of taxes, but you will be entitled to your $1 million with zero in taxes, potentially, given the current tax code. So this is why, because the contributions that you as the employer withheld, collected, remitted, and reported, because your employees got no tax benefit for it, except for maybe the savers credit, they can withdraw their contributions if they want to. If their contributions have grown, so maybe they've been putting money in CalSavers with you for 6 months, maybe a year, and maybe the stock market has been great, and their $1,000 became $1,500, they withdraw the $1,500, everything else being equal, the $1,000 contribution that they made will not be taxed, but the $500 earnings, they will pay tax on that. And depending upon their age and other circumstances, they may also pay a 10% penalty on it. Should you be teaching this to your employees? No. I'm telling you because you may be a sole prop, also required to be in a CalSavers plan. You may be a partner, you may be an LLC member. I'm speaking to you. Do not share this stuff with your employees. Mum's the word. Cannot say that enough. So I'm sharing this for your knowledge, not to impress your employees. Anything you want to add to that, Mike?
No,
Or any questions?
no, just keep in mind, I keep repeating it. If you
All right.
provide information to, and you're not an expert, doesn't matter if it's this or something else, by the way, it could cause problems for you.
Yes.
Don't try to be an expert in areas you don't know anything about or know little about.
Very good point, Mike, because what I'm sharing with you today are broad strokes. This stuff is this thick, and I've condensed it to 10 slides to speak with you in a matter of 45 to 50 minutes. This stuff is ripe for lawsuit, for penalties, for a lot of things. It is designed, as Mike said, it is designed to help. You're not designed, you're not asked, you're not allowed to help. You're just a conduit between your employee and the state. You're in the middle. Either you stay in the middle and participate in CalSavers, or get out and bring in a TPA to offer SEP, 401k, or something else along the way. But right now, you're just a conduit in the middle to help your employees. This is not to help.
Right. If an employee came to you and said, how do I build a house? And you know nothing about pouring a foundation, how to build a house, and give advice, you're not doing your employees any service.
Correct.
Right? Tell them to go to a professional.
So I end the presentation with to save or not to save. You don't have a choice. You must offer the platform. Your employees have the choice whether they want to save or not. But you must, if you are deemed by the state of California to have 5 or more employees, sole props, partners, LLC members, whatever, and part-time or full-time employees in state or out of state. Now remember, one thing I'll make it clear. If you have an employee in New York and you have registered with New York and you're paying and withholding taxes in New York, they do not count as your employee in California. But if you have an employee who moved to California, is a non-resident, but is still domiciled in California, they count. So be very careful with the distinction between residency and domicile. Resident and non-resident employees count for these purposes.
Thank you, GB.
Thank you, sir.
We're coming towards the end of the hour. Next week, I have a presentation. We're going to take a step back away from this on how to set up accounting cycles and how to set up your accounting system, charts of accounts, and those types of things.
Perfect.
If you're willing to help us out with that, GB,
Absolutely.
that'd be great.
Honored to.
Okay. So great. Thank you, Lauren, as always. Thank you, everybody, for attending, and we'll see you next week at the same time.
Thank you.
Great day. Bye now.